In September 1929, Irving Fisher, the most respected economist in America, stood before a crowd of investors. He made a prediction that would destroy his reputation forever. He said, "Stock prices have reached what looks like a permanently high plateau. I do not feel there will be soon, if ever, a 50 or 60-point break from present levels." 9 days later, the market crashed. Within 3 years, stocks had lost 89% of their value. 25% of Americans were unemployed. Banks failed by the thousands. The Great Depression had begun. Irving Fisher wasn't a fool. He was a Yale professor, a mathematical genius, the founder of modern monetary theory. But he made one fatal mistake. He believed that this time was different. That new technologies, automobiles, radios, electricity, had created a permanent new era of prosperity. That the old rules about valuations and debt didn't apply anymore. That the market could only go up. He was catastrophically wrong. And here in 2025, we're hearing the exact same words. This time is different. AI has changed everything. Productivity is exploding. The Fed has everything under control. Stocks can only go up. The parallels between today and 1929 are not subtle. They're screaming. Margin debt at all, time highs, asset bubbles in stocks, real estate, and crypto. Overconfidence so extreme that any mention of risk is mocked. And most terrifying, the same delayed crash psychology where every dip is bought, every warning is ignored. Everyone believes they'll get out before it falls. In the next 10 minutes, I am going to show you the exact parallels. Between 1929 and 2025, why the crash psychology is identical, what the specific triggers were then and now, and the timeline for when this breaks. Because the pattern doesn't repeat exactly, but it rhymes. Let me start by showing you what 1929 actually looked like. Because everything you learned in school is wrong. You were taught that the crash was sudden, unexpected, that it came out of nowhere. That is false. The warning signs were everywhere. People just chose to ignore them. The 1920s were called the Roaring Twenties for a reason. After World War I ended in 1918, America entered a decade of explosive growth. New technologies were transforming daily life. Cars, radios, refrigerators, washing machines. Productivity was soaring. Corporate profits were breaking records every quarter, and the stock market was going straight up. Between 1921 and 1929, the Dow Jones Industrial Average went from 63 to 381. That is a 500% gain in 8 years. The financial media of the day called it the new era. They said the old economic cycles were over. That technology and modern management had created permanent prosperity. Sound familiar? But beneath the headlines, something dangerous was building. Debt, specifically margin debt. In the 1920s, you could buy stocks with just 10% down. That means with $1,000, you could control $10,000 worth of stock. If the stock went up 10%, you doubled your money. But if it went down 10%, you lost everything. By 1929, margin debt had reached $8.5 billion. That was nearly 10% of the entire US GDP. Everyone was borrowing to buy stocks they weren't investing. They were gambling with borrowed money. On the 3rd of September 1929, the Dow hit its peak at 381. Irving Fisher made his permanently high plateau prediction on the 5th of September. Then cracks started appearing. Steel production began declining. Car sales were falling. Unemployment was ticking up. But the market kept going up because everyone believed in the new era. This is the delayed crash psychology. When fundamentals deteriorate but prices keep rising because of momentum and borrowed money, not underlying value. On the 24th of October 1929, Black Thursday, the crash began. Margin calls went out. People who'd borrowed to buy stocks were forced to sell. The selling triggered more margin calls, more forced selling, a cascading collapse. Within hours, billions in wealth evaporated. But here is what is critical to understand. Most people thought it was just a correction, just a temporary dip. The president, Herbert Hoover, went on radio and said, "The fundamental business of the country is sound." Financial experts told people to buy the dip. Many did, and they were destroyed because this wasn't a correction. It was the beginning of a collapse that would last 3 years. By 1932, the Dow had fallen from 381 to 41, an 89% decline. Not over days, over years. Slow, grinding, relentless destruction of wealth. Banks failed. 9,000 banks, about 40% of all banks in America, went under. Why? Because they'd lent money to stock speculators who couldn't pay it back. When the stocks collapsed, the loans defaulted and the banks failed. Unemployment hit 25%. 1 in 4 American workers couldn't find a job. Not because they were lazy, because the jobs didn't exist. Foreclosures exploded. People lost their homes, their farms, everything. Shanty towns called Hooverville sprang up in every major city. The Great Depression lasted a decade from 1929 to 1939. It only ended when World War II forced massive government spending. An entire generation was scarred by the experience, and they all asked the same question. How did we not see it coming? The answer, they did see it. They just didn't believe it, because this time was different. Now, let me show you 2025, and let me show you why the parallels are terrifying. In 1929, margin debt was 10% of GDP. Today, margin debt in U.S. stock accounts sits at approximately $800 billion. As of late 2024, that is about 3% of GDP, lower than 1929. But here is the catch. That is just official margin debt. It doesn't include leveraged ETFs that use 2 times or 3 times leverage. Options trading, which is leveraged by definition and has exploded to record levels. Crypto trading on platforms that offer 10 times, 50 times, even 100 times leverage. Or private credit and shadow banking lending against portfolios. When you add all forms of leverage in the financial system, we're at levels that equal or exceed 1929. Retail investors. Regular people are using leverage like never before. Robinhood, meme stocks, options trading in 2021. During the GameStop saga, retail investors were buying billions in call options. That is pure leverage. They were borrowing implicitly to amplify gains. This is the exact psychology of 1929. The belief that stocks only go up, so borrowing to buy them is free money. Margin debt spiked to $936 billion in 2021, an all-time record. It has declined to $800 billion but remains at historic highs. Every previous peak in margin debt has preceded a major market crash. 2000. Bubble 27 financial crisis 2021 meme stock peak. We are at the 3rd highest margin debt level in history right now. In 1929, the bubble was concentrated in stocks. Today, we have simultaneous bubbles in multiple asset classes. The S&P 500 trades at a Shiller PE ratio of approximately 30. The historical average is 16. That means stocks are trading at nearly double their long-term average valuation. The only times higher were 1929, 2000, and 2021. We're at 1929 levels right now. The Magnificent 7 tech stocks account for over 30% of the S&P 500's total market cap. That concentration is higher than any point in history except 2000. If those 7 stocks fall, the entire market falls. Home prices relative to income are at the highest level ever recorded, surpassing even the 2006 housing bubble peak. The median home price is 7.5 times median household income. Historically, it has been 3 to 4 times. Bitcoin, Ethereum, and thousands of other cryptocurrencies have created a $2+ trillion market with zero intrinsic value, producing no cash flows, existing purely on speculation. This is the everything bubble. Stocks, housing, crypto, private equity, all inflated simultaneously. 1929 only had stocks. We have 4 asset classes in bubble territory. In 1929, the narrative was technology has changed everything. Cars, radios, electricity were transforming American life. Productivity was soaring. The old rules didn't apply today. The narrative is identical. AI has changed everything. We're entering a new era of productivity. The old valuation models don't apply to tech companies. This is the most dangerous parallel because it is psychological. In 1929, anyone who warned about valuations was dismissed as old-fashioned, as someone who didn't understand the new era. Today, if you warn about valuations, you are told you don't understand exponential growth or don't understand AI. The language is different. The psychology is identical. Here is a direct quote from John J. Raskoff, a General Motors executive in 1929. "Everybody ought to be rich. A man who saves $15 a week and invests in good common stocks will be worth $80,000 in 20 years. Compare that to today's crypto influencers. Just buy Bitcoin and hold, you'll be rich in 10 years. The exact same overconfidence. The exact same promise of effortless wealth. And this brings us to the most dangerous parallel: delayed crash psychology. In 1929, there were warning signs for months before the crash. Steel production peaked in June 1929, 3 months before the crash. Car sales started declining in early 1929. Building permits fell. Unemployment ticked up. But the stock market kept rising. Why? Because of momentum. Because everyone believed stocks only go up. Because every dip was bought. Today, we're seeing the exact same pattern. Corporate earnings growth has slowed. Consumer debt is at all-time highs. Credit card debt over $1 trillion. Student loans $1.7 trillion. Auto loans at records. Savings rates have collapsed to less than 4% of income, but the stock market still near all-time highs. This divergence between fundamentals and prices is the warning sign. And just like 1929, every dip is being bought. Every correction is met with buy the dip mentality. The psychology is the Fed won't let markets fall. Stocks only go up. You can't time the market, just stay invested. These mantras are true in normal times, but they're suicide when you are in a bubble. Because in 1929, people who bought the dip in October lost everything by 1932. The dip kept dipping for 3 years. Let me show you the exact mechanism of how the 1929 crash unfolded, because understanding the sequence tells you what to watch for now. First, peak confidence in September 1929. Markets at all-time highs. Experts declaring new era margin debt at records. Everyone is bullish. Then the crack on the 24th of October, Black Thursday. A seemingly small piece of bad news. A decline in steel production triggers selling. Initial selling triggers margin calls. People who borrow to buy stocks are forced to sell. Then the cascade on the 28th of October 29. Forced selling triggers more margin calls. More margin calls trigger more selling. This is a self-reinforcing feedback loop. Panic sets in, everyone rushes for the exit at once. But there are no buyers. Prices free all. Then comes the rally in November. After the initial crash, markets rally 20%. Everyone thinks the worst is over. Experts say the bottom is in. People buy back in. This is the bull trap, the deadliest phase. Then the grinding decline from 1930 to 1932. The rally fails. Markets start declining again, but slowly grinding. Not a single crash, but a series of lower highs and lower lows over years. Anyone who bought the rally loses everything. Finally, economic collapse from 1930 to 1933. Stock collapse destroys wealth. Destroyed wealth means less consumer spending. Less spending means companies fire workers. Unemployment rises. Rising unemployment means more defaults. Defaults mean bank failures. Bank failures destroy more wealth. The doom loop is complete based on the 1929 pattern and current indicators. Here is the most likely timeline. Right now in 2025, we're at peak overconfidence. Margin debt elevated. Valuations extreme. Warning signs appearing but being ignored. Markets still rising on momentum. Sometime in 2025 to 2026, the crack happens. A trigger event could be a bank failure, geopolitical crisis, inflation spike forcing the Fed to raise rates, major corporate bankruptcy or debt ceiling crisis. Whatever the trigger, it causes initial selling. Margin calls go out. The cascade begins. Then 2026 to 2027, the crash and bull trap. Markets fall 30 to 40% rapidly, then rally 15 to 20%. Media declares bottom is in, retail investors buy back in. This is the trap from 2027 to 2029. The grinding decline. Markets fail to make new highs, start declining again. Slow, painful, relentless unemployment rises. Corporate bankruptcies accelerate. Housing market crashes. Finally, 2029 to 2031. The bottom, markets down 60 to 70% from peak. Unemployment at 15 to 20%. Massive government intervention. This timeline is not prediction, it is pattern recognition. So, what do you actually do right now? First, reduce equity exposure. If you are 100% in stocks, move to 50 to 60% stocks maximum. The other 40 to 50% in cash, short-term treasuries, or gold. Second, eliminate margin and leverage. If you are using any borrowed money to invest, pay it off now. Margin debt is what kills you in a crash. Third, hold cash for the crash when markets fall 60%. That is when you buy. But only if you have cash. Most people will be fully invested and unable to buy the bottom. Fourth, own some gold. In 1929 to 1933, gold was the only asset that held value. Stocks fell 89%. Gold stayed constant. Fifth, prepare for unemployment. Have 6 to 12 months expenses saved. The Great Depression put 25% out of work. Nobody thought it would happen to them. And finally, don't try to time the exact top. You won't. Nobody does. Just reduce risk now while things better to be a year early than a day late. In September 1929, Irving Fisher said stocks had reached a permanently high plateau. 9 days later, the crash began. He lost his entire fortune, died in relative poverty, spent the rest of his life trying to understand how he'd been so wrong. He was wrong because he believed this time was different. That technology had changed everything, that the old rules didn't apply. He was wrong because he confused a liquidity-driven bubble with genuine value creation. Clears throat. He was wrong because everyone around him was saying the same thing, creating an echo chamber of overconfidence. In 2025, we're hearing the exact same words. This time is different. AI changes everything. The Fed has our back. Stocks only go up. The leverage is the same. The overconfidence is the same. The delayed crash psychology is the same. The only question is timing. The 1929 crash didn't happen because of bad news. It happened because the system was so leveraged, so overvalued, so fragile, that any piece of bad news could trigger the cascade. We're in the same position now. The system is fragile. Leverage is extreme. Valuations are absurd. Any trigger and it goes. You cannot predict the trigger. You can only prepare for the cascade. The Great Depression taught us that markets can fall 89%. That crashes can last years, not days. That buying the dip can destroy you if you are early. That the people who survive are the ones who reduce risk before it is obvious. In 1929, they said it was different. It wasn't. In 2025, they're saying it again. It isn't. The pattern is 100 years old and it is about to repeat. If this changed how you see 2025, subscribe immediately. The next video breaks down exactly which sectors crash first, which assets to buy at the bottom, and the specific signs that tell you the cascade has started. The Great Depression 2.0 is not a prediction, it is a pattern. And patterns don't lie.